Okay, yes, we are live now. We are live now. Good morning everyone, and welcome to this live session of SPM BVM Marathon. Yes, we are live now. Please confirm in the chat box if I am audible to you. If I am visible to you, please confirm in the chat box whether are you able to see me. Are you able to see me? Please confirm if I'm audible. Please confirm if I'm visible to all of you, because we are going to start the marathon of SPM BVM with all of you today. Please confirm if I am visible to you. Please confirm if I am audible. Okay, yes, we are live now. Please confirm if I am visible to you. Please confirm if I am audible to you. Okay, yes, we are live now. Good morning everyone, and welcome to this live session of SPM BVM Fast Track batch. Yes, we are now starting the marathon lectures of SPM and BVM. That is the target. Please confirm if I am audible to you, if I am visible to you. Yes, good morning everyone. Yes, I can see your chats. Your chats are amply visible to me, guys. Yes, good to go live. Yes. Good morning, guys, and welcome to this live session of SPM and BVM. And yes, last week we had concluded the live session, the marathon session of cost and management audit, and now we are starting the live session of SPM and BVM. Good morning everyone, and thank you so much for showing so much interest in cost and management audit marathon lectures. And it was really an amazing journey with all of you when you really cooperated, really participated in the marathon with great spirit. And I really hope and pray that you score good marks in both cost audit and SPM BVM. And trust me, guys, just like cost audit, SPM BVM is also a very scoring subject. Getting 80 plus in SPM BVM is not difficult at all. Yes, the target is getting 80 plus for SPM and BVM. Yes, good morning, all good to go. Okay. Welcome, guys, and welcome to this session of SPM and BVM. So we are starting the marathon lectures of SPM BVM, and in this marathon lectures we'll try to quickly cover the most important chapters, the most important topics of the entire syllabus. I'll be giving you some practice questions as well. If you practice those questions well, and if you cover the entire syllabus according to this marathon lectures, and if you have very less time, okay, the time is really less with all of you, and you're wondering that, we want, sir, one package where, within about 20 hours we'll be able to cover the major topics or revise the major topics of SPM BVM, then this is the perfect solution for all of you. However, I always say that these marathon lectures or these fast track lectures are never a substitute to the full batch. Full batch is something which is always recommended because it's a professional examination, and that too final of a professional examination. So a full batch is definitely recommended. Always it is really better to always take the full batch. But even if you don't take the full batch, and if you are revising the entire syllabus in a very short span of time, then these lectures will help. Okay. Yes, these lectures are starting today. They'll run for about, say, 10 to 11 days. We'll be meeting daily 2 hours each session will be organized, and this entire lectures will be finished in next 10 days. Okay, we are starting from today, so just count 10 days from today. In about 10 days, we'll be covering most of the important topics of the syllabus of SPM BVM. So what topics are you going to cover? I'm going to cover 100% of SPM topics, which means that all the 4 chapters where the theoretical and practical portion is coming in the examination. I'll cover all the 4 chapters of SPM, Strategic Performance Management. Of course, I'll be picking up relevant topics from those 4 chapters, but yes, I'll be touch basing all the 4 chapters of SPM. As far as business valuation is concerned, for business valuation, guys, I'll be taking up chapters which are as under. I will be taking up mergers and acquisition, human resource accounting, intangible, investments, laws and compliances. These 5 chapters I'll be taking for your marathon session, for this entire period. So yes, for next 10 days we'll be jam packed with some really quick revision, really quick updates on all the important topics of your syllabus, and covering them really quick so that you are well prepared. Actually, this is an effort to cement your preparations which you have already done from your earlier batch, the full-fledged batch. Whether you have done it self or you have taken a coaching from it, doesn't matter. This marathon lecture or this revision lecture is going to supplement your preparation, is going to cement your preparation, further will prepare you for getting 80 plus marks in your SPM BVM. The target is not less than 80 plus marks in both cost and management audit, SPM BVM. And guys, if you have not yet subscribed to the cost audit marathon lectures, then please talk to my team on this number and subscribe to the cost audit marathon lectures also. Over there also, within a span of say 20 to 25 hours, we have completed all the important chapters of cost and management audit, including theory and practical portions. Practical portions are really important in cost audit, which generally students ignore. They feel that, sir, cost audit is all theory, so we will ignore practical. So students generally ignore practical. So this entire effort is towards that direction, that you do not ignore any important stuff, and according to the past trends, according to the past papers, we analyze which chapters are important, which chapters are not important, and then we go about this marathon session. Okay. Now guys, one thing which is to be remembered always in professional examination is that there's a concept called googly in the professional examination, which means that certain questions from in your examination will come that you will not be able to recognize which chapter is this question from. Yes, they'll be so confusing. Those questions will be so confusing. This is an attempt to test your patience. This is an attempt to test whether you are fully prepared for the examination or not, whether you are unconfident, and to panic you, to create panic inside you. Such questions are always deliberately put by the question paper maker in the examination. They will test your patience. They will test your restlessness. So always face googly in a very confident manner, because googlies are meant to be played, but with caution. Okay, whatever you understand, whatever you are able to calculate in a googly question, you do it to the best of your ability, to the best of your caliber. You just attempt that googly question, and that's it. The aim is not to entirely attempt the googly question. The aim is not that. The aim is to just attempt it to the extent of 20, 30, 40, 50, whatever percentage we can, and obtain whatever marks we can. Of course, if we have the option of ignoring googly, using the choice of the choices which we get, the options which we get, then we can ignore the googly altogether. But if we have to attempt it, then we will attempt it, and we will attempt it in a way that we are going to not hit 6 out of it, but just get some reasonable score out of it. Okay, so please understand this concept of googly, which is there in the examination. And yes, for past few examination, SPM BVM, there's a googly question which is being asked by the examiner, and students get a little jittery. That's SPM BVM paper was very difficult. Just having just one question which is difficult doesn't make the entire paper difficult. Please understand this fact. Your entire preparation, your merger and acquisition chapter, your assets and liabilities, which is investments and HRA and everything, all these chapters are holding very important place in your question paper. So don't ignore these chapters. These chapters are equally important. And plus, SPM, strategic performance management, economic efficiency. There's a simple question which is coming from economic efficiency in every attempt. That is absolutely a no-brainer. It's a very simple question which we'll be dealing in our class also. Then we have a question from risk management, and that question is quite popular, which is coming regularly in the examination. So don't worry about googlies which come in the examination, but focus on the portion that you are aware of, that you understand. That is the only way to get through the paper. So yes, we are going to start the marathon lecture today, and I've given you a brief snapshot of the marathon lecture. We'll be covering all the important topics. I'll try to cover 70-80% in marks percentage, in marks term of the entire syllabus. I'll try to cover this much syllabus. Theory and practical both will be covered by me. Again, depending upon importance, what is the importance of that particular chapter, what is the importance of that particular topic. According to that, I will choose which chapters to be taken up, which chapters not to be taken up. So theory and practical both will be dealt with by me. Approximately 25 hours, okay. So 20 to 25 hours of lectures will be provided to you, and yes, within this time span we'll be able to cover the entire syllabus. So 20 to 25 hours will be provided to you. Soft copy book will be provided to you. Soft copy PDF book will be provided to you, not in hard book. And this for obtaining this PDF, you have to join this WhatsApp number. There's a WhatsApp group which has been created especially for this marathon, 9643929913. On this number there's a WhatsApp group. Please join the WhatsApp group so that you get live updates on what is happening on this marathon lecture. Plus initial classes will be live on YouTube, just like you are seeing this particular video, which is live on YouTube, which is an open source. But after 2-3 classes we'll be moving to the app, and we'll have the classes in the app. So get yourself registered for the app as well as soon as you can. Initial classes will be given live on YouTube, just like you are watching the video right now. English language, this batch will be entirely in English language, so that even the South Indian students can understand it and can take maximum benefit out of it. So language will be purely English. I will not be using Hindi at all during this particular session. And guys, those who are giving the examination, they obviously know that they have to give the paper, they have to write the paper in English language only. So don't say that, so sir, we find English difficult to understand, etc., etc. Please don't say that, because you have to write your paper in English language only. So English will be the language in which this entire batch will be conducted. And of course, this batch is not a substitute to the full batch. I've already made you understand this fact that, if you think that, sir, we will not take the full batch at all and we will just study using the marathon batch of cost, right, and BVM SPM, trust me, it is not going to help, because in marathon session or in fast track batch, we don't delve into the concepts so much. We don't delve into the concepts, and we primarily focus on the solving the questions. So this is not a substitute to the full batch. That is one important thing that you really need to be aware of. So please use this batch as a supplement or as a complement to your main batch. It will cement your preparations. The idea is not to start your preparation afresh using this batch. It is the idea is to cement your preparations, which you have already done in your full-fledged batch or when you are studying for your own. Okay, sir, got it? So yes, let's start today's session, and today's session is dedicated to one of the most important chapters of your syllabus, which is mergers and acquisitions. We are going to start mergers and acquisitions today, and trust me guys, this chapter holds approximately 15 to 20 marks in your examination. There have been times, there have been attempts where this chapter has come for 25 marks. Yes, this chapter has come for 25 marks in the examination. There have been attempts like this, but bare minimum 15 marks question you can expect from this particular chapter. It is by far the most important chapter of your syllabus. Of course, pure practical question will be there. Pure practical approach will be there in this particular chapter, because no theory portions generally come from this chapter. So yes, this is the chapter on valuation of mergers and acquisitions. So this chapter is valuation of mergers and acquisitions. Valuation of mergers and acquisitions. Let's start this chapter and let's see what is the framework, what is the concept of mergers and acquisition. First of all, I would like to ask all of you to calculate for me a simple equation which I am writing in front of you. Okay, so what is 1 plus 1? Please answer my questions in the chat box. मेरे सवालों का जवाब दो. And guys, do hit a like button. Okay, If you're watching, if you're live, then live will communicate your feelings to me. So do hit a like button. So your like will definitely motivate me. Okay, please do hit a like button. So what is 1 plus 1? I want to ask all of you, what is 1 plus 1 in mathematical term? Yes, you all have studied mathematics. So what are you asking, sir? We are, CMA final students. What are you saying? You are asking us 1 plus 1? No, I don't want philosophy. The philosophical students, please beware. I don't want philosophy. So 1 plus 1 is equal to 11. एक और एक 11. हमारी ताकतें सर कई गुना हो जाती हैं अगर दो लोग मिल जाते हैं. Philosophical answers I don't need. I want mathematical answers. Mathematical answers. What is 1 plus 1? Ajay More says 1. How can 1 plus 1 be 1? Okay. Amir says 2. Luffy Wish says 3. Jyoti says 1. Mohit says 2. Okay. So mathematically 1 plus 1 is equal to 2, but according to mergers and acquisition, 1 plus 1 is equal to 3. That is the golden principle of mergers and acquisition, which you need to first of all understand, that 1 plus 1 always should be 3. 1 plus 1 is equal to 3. That is the fundamental rule which is followed under mergers and acquisition. So why do you say that? So this is a mathematical error. This is an error in mathematics. No guys, this is not an error in mathematics. This is the principle which we follow in mergers and acquisition. I'll explain you how. So there are two companies. A Limited and B Limited. They both merge together to form a new company, AB Limited. The idea is to work together. So both these companies merge with each other, or one company acquired the others, or any other kind of combination. Some combination happens and A company and B company are working together to form AB Limited. Now please see the the analogy. Okay, so net profits which are earned by A Limited is 3 crores. Net profit which is earned by B Limited is 5 crore. Net profits which are earned by A Limited is 3 crores. Net profit which are earned by B Limited is 5 crores. So 3 plus 5 usually should be 8 crores. But in a merger and acquisition scenario, it has to necessarily be more than 8 crores. Unless and until two companies are merging together and they are reaping a little more extra profit than what was being earned by them before merger, this merger is not worthwhile. Why would I undertake the entire pain of going to the entire legal process of merger and acquisition and incurring the expenses of merger and acquisition unless and until I find some benefit? There has to be some benefit. There has to be something extra that one is earning because of this merger and acquisition effect to sustain this merger and acquisition. Otherwise, this merger and acquisition is a waste of time, it's a waste of money, it's a waste of effort. So when two companies come together, so when the two companies are combined with each other, either as a merger or an acquisition, whatever mode, when two companies are combined with each other, then the resultant company should have a little higher results as compared to the individual two companies alone. So the resultant figure should be higher than the individual figures. Yes, it can be 9 crores also, it can be 8.5 crores also, but it has to be more than 8 crores for sure. This is the principle which we follow under merger and acquisition, that guys, if two companies are joining hands, then there has to be some synergies. Synergy means the benefit of working together. And yes, over here the synergy is monetary. There can be non-monetary synergies as well. Yes, there can be reasons which are beyond monetary reasons because of which the companies are merging together, that are also acceptable, but there has to be some synergy benefit. There has to be something extra which the companies are earning because of the merging effort and acquisition effect. Only then merger and acquisition is actually fruitful. Otherwise, merger and acquisition is waste. It is waste of time, waste of money, waste of efforts if your merger and acquisition is not resulting into any synergy benefit. What do you mean by synergy? Synergy means when two forces work together, when two forces come together, they result into synergy. So if synergy is not there, then the merger and acquisition is an absolute waste. It's an absolute waste of effort, time and money. So the golden principle which we follow in merger and acquisition is that 1 plus 1 should at least be 3. It can be more than 3. It can be 4, 5, 6, 7, 8, 9, whatever. But it has to bare minimum be more than 2. It cannot be 2. It has to be bare minimum more than 2. This is the golden principle of merger and acquisition. While valuing merger and acquisition deals also, we will keep this thing in mind that there is something called synergy. There is something called extra benefit which accrue to the organizations as a result of this merger deal. There's something extra which results into these merger and acquisitions. So yes, this is the first principle, that there is something called a synergy effect. Now let us come on to our notes which I have shared with all of you on the WhatsApp group, okay? And those students who will be shifting to the app, these notes are saved in the app as well. If you see the app, then in the app you will get these notes in PDF. These are in printable format. Hard books will not be supplied to you as a part of this marathon lecture. These notes will be supplied to you only in soft copy, only in PDF format, which is printable format, so you can get them printed. In the app you can download these notes, or in the WhatsApp group I've already shared in the notes today morning. This is the number on which WhatsApp group is created. Please go on that WhatsApp group and you can download the notes from that WhatsApp group. Alright sir, got it. So valuation of merger and acquisition, the first thing is analyzing the premium offered to the target stockholders. Premium is nothing but the synergy benefit, okay? So synergy which accrues as a result of merger and acquisition, it is to be shared by both the companies. One is the bidder company, one is the target company. Bidder company means the company which is acquiring other company, and target company is the company which is getting acquired. So bidder company and target company are the two companies which are parties to this particular deal. So a purchase premium in the context of merger acquisition refers to the excess that acquirer pays over the market trading value of the company's shares being acquired. So whatever company is being acquired, as compared to the market value, there's something extra which might be paid to the shareholders of that particular company. That is known as a premium to the stockholders. Now, what do you mean by a swap ratio? A very, very important element. What is the meaning of a swap ratio and how is it relevant in a mergers and acquisition deal? Again, I'll take example of two companies. This is a bidder company and this is a target company. This is a bidder company, this is a target company. Now, assume that the market price per share of bidder company is rupees 100 and bidder company has number of shares as 10,000 shares are there of the bidder company. This is the target company which is getting acquired. So what will happen is all the assets and liabilities of the target company will be transferred to the bidder company. All the assets and liabilities of the target company, assets plus liabilities of the target company will be transferred to the bidder company. This will happen. Okay, and in return the bidder is going to pay consideration to the target company. In return, the bidder is going to pay consideration to the shareholders of the target company. Whosoever are the owners of the target company, they will get some consideration, they will get some compensation from the bidder company. That is a usual merger and acquisition deal which happens in usual scenario. Now, assume that bidder company has market price per share of rupees 100 and their number of shares are 10,000 shares are there of bidder company. And for target company, the market price per share is rupees 50 and the number of shares are 8,000. So there are 8,000 shares, shareholders who are there for the target company, and the market price per share of each share is rupees 50. Now what will happen is, all the assets and liabilities of the target company will be transferred to the bidder company and a net asset value, NAV, will be calculated. That was the NAV. Okay, NAV will be calculated. Now the bidder company will issue some consideration to the target company. Assume that this consideration is wholly in terms of number of shares. So the bidder company will issue new shares to the target company. That is a deal. There is no cash involved. Assume that there is no cash involved. One way of fulfilling the consideration is to pay cash. That is for sure there. Okay, you can pay cash. That's okay. But another way is that to pay to the target company, we are issuing shares and not cash. So assume that the entire consideration will be satisfied in terms of shares to the target company. So target company shareholders will acquire shares of the bidder company. Now you tell me in the chat box, the existing number of shares are 8,000. Existing number of shares are 8,000 and the market price of the share, which is equal to the NAV, net asset value, is also the same, 50 rupees. Okay, assume that both of them are same. This represents the NAV of the target company. So assume that both are same. Now 8,000 number of shares are there and 50 market price per share is there for the target company. Now target company is asking bidder company, you give us your shares and you take assets and liabilities from us. So what will target company require? Target company will say, look, bidder company, you give us 8,000 shares of yours to us, because we are 8,000 shareholders. Okay, we are 8,000 in numbers. So you give us 8,000 shares of yours to us and we will surrender all our assets and liabilities to you. In this case, the bidder company will be little reluctant. What will bidder company say? Bidder company say, no. What are you saying? Your shares value is only rupees 50. My shares value is double than your shares value. Your shares value is rupees 50. My shares value is double than your shares value. So I cannot give you 8,000 of my shares. The fair deal will be that I will give you 4,000 of my shares. I will give you 4,000 of my shares to get equivalent value in your company. So 8,000 is represented by 50 market price per share, right? Now when this 8,000 will be converted to 100 market price per share, the number of shares will be reduced to half. So bidder company will tell the target company, no, I am not going to issue 8,000 shares. 8,000 shares is too much. I am not going to issue 8,000 shares to you for sure. So what will you issue? So bidder company will issue 4,000 shares, because 4,000 shares multiplied by 100 will get the same value as 8,000 shares multiplied by 50, because the worth was less. No, the worth was less. The worth of target company shares was less. So 8,000 shareholders will get 4,000 shares in the bidder company to have a fair deal. And this exchange ratio is known as the swap ratio. This exchange ratio is known as the swap ratio. So how many shares of a bidder company will be issued to the target company shareholders? That is known as the swap ratio or the exchange ratio. So what is the exchange ratio in this particular case? Exchange ratio is 0.5:1, which means the target company number of shares is 8,000. It is multiplied by 0.5. So we get to know how many shares are we going to get in the bidder company. Target company shareholders will get 4,000 shares in the bidder company. If you understood this concept, please write yes in the chat box. It's a very, very important concept, a very basic and a starting level concept of mergers and acquisition chapter. Okay, so 8,000 multiplied by 0.5. Now, where does this 0.5 come from? 0.5 is derived by dividing the market price per share of the target company by the market price per share of the bidder company. Market price per share of the target company divided by market price per share of the bidder company. What is the market price per share of target company? It is 50 rupees. What is the market price per share of the bidder company? It is 100 rupees. So 50 divided by 100 is equal to 0.5. So 0.5 is the swap ratio or the exchange ratio. Swap ratio or the exchange ratio. If you understood the concept, please hit a like button. Okay, I need to see a lot of likes and hearts being sent by you to me. Lot of hearts and lot of yes, very good. Swap ratio clear, sir, on the basis of MPS. Very good, perfect answer. Yes, so this is nothing but the swap ratio. Now, similarly, swap ratio can also be calculated using earnings per share. Whatever is the earning per share of the bidder company versus earning per share of the target company, using that also you can compute the swap ratio. So, now what is the formula of swap ratio? Formula of swap ratio is, so first of all, let's read the definition of swap ratio. Swap ratio is the ratio at which an acquiring company will offer its own shares. Acquiring company means the bidder company will offer its own shares in exchange for the target company's shares during a merger or acquisition. For example, 10 shares of target company are exchanged for 1 share in the acquiring company. In this case, the swap ratio is 1:10. So it depends what shares are being offered by the bidder company to the acquiring company. That ratio is known as swap ratio or the exchange ratio, and this exchange ratio forms the basis of our calculation in the case of mergers and acquisition. Okay, so basis of computation of swap ratio. So swap ratio can be computed on the basis of EPS, MPS, book value per share, net asset value per share. So all these measures are used to calculate the swap ratio. So what is the formula of swap ratio? So formula of swap ratio is EPS or MPS or BVPS or NAV of the target company or the acquired company divided by EPS or MPS or BVPS, whichever you choose. Okay, you choose any one of them, whichever you choose, of the bidder company or the acquirer company or the buying company. So you have to always keep the target company's parameter on the numerator, target company's parameter on the numerator, and bidder company's parameter on the denominator. This is how you should always use this formula of swap ratio. This is a formula of swap ratio. Please comment a yes if you understood this entire formula of swap ratio. Please comment a yes. Yes, very good, superb. Superb. Now let us start the next topic, and the next topic is new earnings per share. What do you mean by new earning per share? What is the meaning of new earning per share? That is what we are going to see now. What is the meaning of new earnings per share? Okay, sir. So, you know the definition of earnings per share, right? So please, can you please calculate for me the earnings per share of A Limited? Please calculate for me the earnings per share of B Limited. Please calculate both of the things for me. I want you to calculate earnings per share of A Limited and B Limited for me. Please calculate and write in the chat box. Earnings after tax of A Limited 5 lakhs, number of shares 10,000. Earning after tax of B Limited 2 lakhs. Number of shares is 5,000. Please calculate the earnings per share for me before merger of A Limited and B Limited. Please calculate the earnings per share for me. In the chat box, please. Perfect. Perfect answer. It is 50 and 40. You just divide earnings after tax with the number of shares and you get the earnings per share of both of these companies. Perfect. Perfect. Very good answer. Very good answer by all of you. Perfect. Okay. Now, you have to tell me what is the new earnings per share of the new company. These two companies have merged together, and after merging it has created a new company which is AB Limited. You have to tell me what is the earnings per share of the new company. How can we calculate the earnings per share of the new company? So if I ask you, what is the earnings of the new company? What is the earnings after tax of the new company? Then you will tell me, sir, earnings after tax of A Limited plus earnings after tax of B Limited plus, will there be something else to the earnings of the AB Limited? So you will tell me that if both the companies are merging together, A and B are merging together to form AB Limited, then the merged firm, which is AB Limited, what is the earnings of AB Limited? Then you will tell me, sir, you first of all add earnings of A Limited, then you add earnings of B Limited, obviously, because both these things are constituting to become a AB Limited. That's perfectly fine, right? Is there something else that I should add? Yes, absolutely right. Sir, there will be some synergy benefit also, because 1 plus 1 cannot be 2. It has to be 3. So there has to be some synergy benefit also. Very, very good answer by all of you. Very, very good answer by all of you. Divided by, what will I do? Number of shares of A Limited. Number of shares of A Limited. Okay. Plus number of shares of B Limited. Plus number of shares of B Limited. Number of shares of A Limited plus number of shares of B Limited. Now, one very important point to be noted over here is, sir, B Limited is being acquired. B Limited is being acquired. B Limited shareholders are being given some new shares of the new company, and shareholders are being, waived off. The number of shares are being waived off. The shareholders of B Limited are being sent off, and they are being acquired by A Limited. A Limited is issuing its own shares to the shareholders of B Limited. So B Limited will have new number of shares in its kitty, which means the old shares of B Limited multiplied by the swap ratio. The old number of shares which are there with B Limited multiplied by swap ratio, this will be the number of shares of B Limited, because B Limited in this case is the target company, A Limited is the bidder company. A Limited is the bidder company, B Limited is the target company. So A and B combined together will form new earnings per share. So numerator you are very well aware of, earning after tax of A Limited, earning after tax of B Limited divided by new shares of A Limited, which remains the same. A Limited is the target company, is the bidder company, remains the same. New number of shares of B Limited. B Limited will be issued new number of shares, like in our earlier example. B Limited was issued 4,000 shares. So the new number of shares will be affected by the swap ratio, which we have to compute. So the new number of share of B Limited will be old shares of B Limited multiplied by the swap ratio. So this is the formula of new earnings per share. This is the formula of new earnings per share. And guys, instead of just mugging up the formula, if you understand the formula, it will be much more beneficial for you in the examination, because you will be able to remember well. So what is the definition of new earnings per share? New earnings per share refer to EPS available to the shareholders post merger. After merger, whatever is the earning per share which is available to the shareholder, that is known as the new earnings per share. Following formula may be used. Earnings of the bidder company, the company which is bidding, earning of the bidder company, plus earnings of the target company, plus the synergy benefits. This is the total earnings that is available to the merged entity, divided by shares of the bidder company plus shares of the target company multiplied by the swap ratio. Shares of the target company multiplied by the swap ratio. And yes, if the question doesn't specify any synergy benefit, then you can just keep it as 0. Synergy benefit can be 0. If the question doesn't specify any synergy benefit, then synergy benefit can be 0. That is also possible. So this is how new earning per share is calculated. This is a theoretical representation of new earnings per share. Before we come on to our other concepts, let us do one very simple question of calculating the exchange ratio first of all. Okay, let's calculate the exchange ratio, and let's see who all are able to calculate this exchange ratio to the perfection level. All right, sir? Yes. So Akash Limited wants to take over Vatsan Limited. So Akash Limited is the bidder company. You always write, okay, and Vatsan Limited is the target company. Vatsan Limited is the target company, and the financial data is given for both the companies. Financial data is as under: preference share capital is given to you, equity share capital is given to you. Equity share capital. So this is like 10, number of shares is 10 and number of shares is 5. Share premium is given over here. Profit and loss account and debentures is given to you, and total of the liability side of balance sheet is given to you. Then fixed assets is given to you, current assets and total of the asset side is also given to you. Profit after tax and preference dividend. So we have been given the profit after tax and preference dividend, and market price per share is also given to you. What should be the share exchange ratio? You have to compute the share exchange ratio to be offered to shares of Vatsan Limited based on these three criteria: NAV, EPS and market price per share. What should be the swap ratio according to these three parameters, and which should be preferred from point of view of Akash Limited, which is beneficial from point of view of Akash Limited. That is also a thing which you need to really compute. Okay, sir. So first of all, we are going to compute the exchange ratio on the basis of NAV, on the basis of EPS, and on the basis of market price per share. So guys, market price per share is already given to us, so we can easily compute the EPS on the basis of market price. But unfortunately, earning per share is not given to us, and net assets value is not given to us for either of the businesses. So we need to compute the earnings per share of both the businesses. We need to compute the net asset value of both the businesses. Okay, sir, got it. So first of all, let's compute the NAV of Akash Limited and Watson Limited. Let's compute the NAV of Akash Limited and Watson Limited, and NAV is a very simple formula, which we are all aware about. What is NAV? Total assets minus outside liabilities. NAV is total assets minus outside liabilities. That is the formula of NAV. So what is the total assets of Watson Limited? The total assets, obviously take it from liability side or take it from asset side. 173 and 61. 173 and 61. Okay, 61 for Watson Limited, 173 for Akash Limited. Okay. Then we have external debentures. Debentures are 10% debentures. Okay. So 5 lakh debentures are there and 15 lakh debentures are there. Then we have preference share capital. Preference share capital 0 and 20. Preference share capital is 0 and 20 for each of the companies, Watson Limited and Akash Limited. Now, what are the net assets? So these are the net assets which is attributable to the shares. So for Watson Limited, it is computed as and net assets which are attributable to Akash Limited is $138. So these are the net assets which are attributable to both the shareholders. NAV is 56 and 138. And how many number of shares are there? Number of shares are, Watson has 5. Akash has 10. So what is the NAV per share? NAV per share 11.2 and 13.8. 11.2 and 13.8 is the NAV. 11.2 and 13.8 is the NAV. Guys, you have to solve this question simultaneously along with me, okay? Students who are seeing the recorded batch, for them also it's an instruction. Don't copy paste the solutions as it is. Solve with me, because in the examination I'm very sure that if you are not able to, if you do not right now practice these questions in writing, then in the examination you might find hindrance in even calculating the basic of basic calculations. You might find some obstacles. So please don't take this chance. Don't audit the questions of BVM. You don't have to just read the questions of BVM. You have to practice it by your own hand. That's very, very important. Okay. 11.2 and 13.8. So now let us see what is the exchange ratio. 11.2 divided by 13.8, NAV of Watson Limited divided by NAV of Akash Limited. So the swap ratio is 0.81 times. What is the swap ratio? Swap ratio is 0.81 times. 0.81 times is the swap ratio. Okay, so now what is the meaning of this 0.81 times swap ratio? It means that Watson Limited, each share of Watson Limited will get 0.81 shares in Akash Limited. So 5 lakh shares are there of Watson Limited. In exchange of these 5 lakh shares, the Akash Limited will issue 5 lakh multiplied by 0.8 shares in its own company. 0.81 shares in its own company. Okay, that is the meaning. So 5 lakhs multiplied by 0.81 shares, it is 4,05,000 shares. So in exchange of 5 lakh shares, Akash Limited will issue 4,05,000 shares to Watson Limited. So what are the shares? Hence the swap ratio of ABC is computed as 0.81 times number of shares issued to shareholders of Watson Limited is 5 lakh number of shares, original number of shares 5 lakh multiplied by 0.81 times, which gives shares as 4,05,000 shares. Obviously guys, Watson Limited will want maximum number of shares to be issued to them. That will be beneficial for Watson Limited. But Akash Limited will think through, okay? Akash Limited will think what is beneficial for him as well, and then accordingly he will issue the shares, okay? So how many shares are issued? 4,05,000 shares are issued by Watson Limited to Akash, by Akash Limited to Watson Limited in the first option. Now let us analyze the second option. Second option is to compute the earnings per share and accordingly find the swap ratio on the basis of earnings per share, okay? Let's see what is the profit after tax and preference dividend given in case of both the companies. It's 24 lakhs and 15 lakhs. It is already given in the question, guys. 24 lakhs and 15 lakhs is the profit. How many number of shares are there? 10 lakh shares of Akash Limited. 5 lakh shares of Watson Limited. 10 lakh shares of Akash Limited. 5 lakh shares of Watson Limited. So earning per share is 2.5 and earning per share is 3. Earning per share is 2.5, earning per share is 3. So what is the swap ratio? On the basis of earning per share, what is the swap ratio? Swap ratio is computed as 2.5 divided by 3. Okay. Akash Limited earning per share is 3. No, it's vice versa. Oh, sorry, it's vice versa. So Watson is 3 and Akash is 3. Akash is 2.5. Okay. So Watson earning per share is 3, which is higher, and Akash's earning per share is lower. It's 3 and 2.5. Okay. So here Watson Limited has an edge. So the swap ratio is computed as 1.25 times. Swap ratio is computed as 1.25 times. That's the swap ratio. Okay, so swap ratio is 1.25 times. What is the Watson Limited shareholder should be issued? How many shares should be issued to Watson Limited? The existing number of shares is 5 lakhs. 5 lakhs multiplied by 1.25 times. Gives me a figure of 6,25,000. So 6,25,000 are the shares which are to be issued and under the second alternative to the shareholders of Watson Limited. Now you tell me, if you are a shareholder of Watson Limited, what will you prefer? Will you prefer EPS as the basis of your calculation, or will you prefer NAV as the value of your calculation? If you are the shareholders of Watson Limited, tell me in the chat box. What will you prefer? You want higher number of shares or you want lower number of shares? You tell me that. Okay. Last is on the basis of MPS. MPS is not to be calculated. It is already given in the question. MPS is 24 and 27. 24 and 27. Already given in the question. $27 1.125. Absolutely right. Absolutely. So if we are Watson Limited, then we will want more number of shares. More the merrier. If the number of shares are high, then it's beneficial for us. We want more number of shares. More the merrier. As many as countless shares we want. We want more number of shares for sure. So yes, if you want more number of shares, then definitely you will opt for EPS as the preferred choice of your calculation of swap ratio. But if you are the shareholders of Akash Limited, then you won't want less number of shares to be issued to Watson Limited. If you are shareholders of Akash Limited, okay, Then you would want NAV to be basis of your calculation. Then you won't want EPS or the MPS be a source of your calculation. So in that case, there will be a reverse situation. So in this case, the swap ratio is 1.125, and Vatsal Limited should issue how many shares? 5 lakh multiplied by 1.125 gives me a figure of 5,62,500. 5,62,500. 5 lakh multiplied by 1.125. Okay, so using 3 alternatives, we have suggested what should be the swap ratio. Now the question is asking, now it all depends on their negotiation, guys. Okay, now our role of a valuer is over. Our role is over in this particular deal. Now it will be between the owners or the promoters of the two companies to decide what ratio do they want, what is the percentage do they want. Now it is up to both of them. Our role is over. We have determined the swap ratio on the 3 bases. That is what was being asked from us. Now a very specific question again has been asked from us, that from the point of view of Akash Limited, what should be the preferred swap ratio. So Akash Limited is the bidder company. Okay, so the swap ratio which will be preferred by Akash Limited will be the swap ratio in which least number of shares are issued to the target company. Yes, the least number of shares which are issued to the target company, and accordingly NAV should be the preferred option for Akash Limited. He will want the deal to close near NAV. NAV should be the preferred option for Akash Limited. And if it was the case of Vatsal Limited, that we would have analyzed whether Vatsal Limited would what is the preferred choice with respect to Vatsal Limited, then our answer would be the maximum number of shares issued, on which basis EPS should be the answer in that case. EPS, earnings per share, should be the answer in that particular case if the choice is made from the angle of Vatsal Limited. If it is made from the angle of Akash Limited, then NAV is the preferred option. So that is how we are judging the relevance of the swap ratios. Yes, NAV will be beneficial. Very good. Perfect. So you understood this concept well. Please write a yes in the chat box if you understood this concept very, very well. If you understood this concept well, please write yes in the chat box. So an important concept from an exam standpoint. Okay, let's move on to illustration number 2. Let's move on to illustration number 2. Illustration number 2 says, the following information is provided related to acquiring firm Mark Limited. So Mark Limited is the bidder company and Mask Limited is the target company. So again, there are two companies, Mark Limited and Mask Limited. Mark Limited is the bidder company. You write somewhere over here so that you remember this fact. Mark Limited is the bidder company and Mask Limited is the target company. The target company is Mask Limited and the bidder company is Mark Limited. These are two companies which are under consideration. So profit after tax of bidder company is given to you, profit after tax of Mask Limited, the target company is given to you. Number of shares outstanding is also given to you for both the companies. Accordingly, PE ratio is also given to you. PE ratio, the formula for PE ratio is MPS over EPS. You should remember these formulas because at any given point in time, the question can ask you to compute the MPS or EPS using the PE ratio. So PE ratio formula should be on your tips, which is MPS over EPS. Okay. Now the ask is, what is the swap ratio based on the current market price? You have to compute the swap ratio on the basis of market price of both the entities. Okay, we will compute it, no problem. What is the EPS of Mark Limited after acquisition? So we need to compute the new earning per share. We need to compute the new earning per share. But sir, tell us something. Sir, while computing the new earning per share, what is the swap ratio that we are going to take? Guys, always remember, if the question is silent on what is the swap ratio that you should take while computing the new earning per share, you will always take the swap ratio which is required to be computed by you in the above point. So in the above point, swap ratio is required to be computed on the basis of MPS. So in the next point, we are going to compute the new earnings per share on the basis of MPS only. That is the way you should understand this part. So what is the EPS of Mark Limited after acquisition? On the basis of current market price, we are going to compute this new earnings per share. What is the expected market price per share of Mark Limited after acquisition? Assuming P ratio remains the same. If P ratio remains the same, if P ratio is not changed, then what will be the the market price per share after acquisition. Next is determine the market value of the merged firm. What will be the market value of the merged firm? What market value will it command in the market if both the firms are merged together? And finally, calculate the gain or loss of shareholders of two independent companies after acquisition. You have to compute what is the profit or loss which has accrued to shareholders of both the companies pursuant to this merger and acquisition deal. Okay, sir, fairly a lengthy question, and this question typically will come for 8 marks in your examination. It's a very common question which comes in the examination with a little bit of tweaking. Okay, some part given here and there, some modulations might be there, but broadly this question comes in this particular format. Let's start illustration number 2. Okay, the first ask is you have to compute the swap given in the question itself. When current market price is not given in the question itself, how will you compute the swap ratio according to current market price? Oh, it's a big problem for me, guys. It's a big problem for me. The current market price is not given in the question. When current market price is not given in the question, how can I compute the swap ratio on the basis of current market price? It's a big problem. Current market price is not given in the question. But sir, we have been given information of profit after tax and number of shares. So what? So we can compute earnings per share using these two things. And if we compute the earning per share, then we simply have to multiply it by PE ratio to compute the market price per share. So yes, market price per share is not given in the question, but all the data which is required to compute the market price per share is given in the question. So will we be able to compute the market price per share? Yes, absolutely we'll be able to compute the market price per share in this case. Okay, sir, got it. So now my first working note will be compute the MPS of Mask Limited and Mark Limited. We will compute the Marks Limited and Mask Limited MPS by using the formula of EPS multiplied by the PE ratio. EPS multiplied by the PE ratio. Okay, sir. So profit after tax is given to us in the question itself. Yes, sir. Profit after tax is rupees 2000 lakhs, and for Mask Limited it is rupees 400 lakhs. For Mark Limited it is 2000 lakhs. Mask Limited is 400 lakhs. Number of shares is 200 lakhs and 100 lakhs. This is all pre-merger. Okay, pre-merger calculation is going on. 200 lakhs and 100 lakhs. Okay, sir. What is the PE ratio which is given in the question itself? The PE ratio is given as 10 and 5. PE ratio is given as 10 and 5. This is the PE ratio. Okay. Earning per share can be calculated by dividing profit after tax with number of shares. So this divide by this. This becomes 10. This becomes 4. 10 and 4 is the earnings per share. Then we can compute the market price per share by multiplying PE ratio with the EPS. Just multiply these two things, you will get the market price per share. Because the formula of PE ratio is MPS over EPS is equal to PE ratio. Okay. So if I reverse this formula, then I get another formula which is MPS is equal to PE ratio multiplied by the EPS. This is the reverse formula. MPS is equal to PE ratio multiplied by the multiply the MPS multiplied by EPS. This is the reverse formula. Okay. So we'll multiply these two. So the MPS is computed as 120. 120. Perfect. Very good. Now, what is the exchange ratio? What is the swap ratio according to 120 formula? So, guys, swap ratio is MPS of Mask Limited divided by MPS of Mark Limited. MPS of Mask Limited is 20, of Mark Limited is 100. So, the swap ratio is 0.2 times. This is the swap ratio. Hence, the swap ratio computed on the basis of MPS is 0.20 times. 0.20 times. This is the computation of the swap ratio. Perfect. If you understood this computation, please write a yes in the chat box that yes sir, we understood the computation. Please write a yes in the chat box. Okay. Now the next task is to compute the new earning per share post merger. What will be the new earning per share? New earning per share of Mark Limited, that is the bidder company post merger, after merger, because this bidder company will have target company also included in it after merger. So you have to compute the new earning per share. You have to compute the new earning per share. Now you have to compute the new earning per share. So what is the formula for new earning per share? Let's see. So the formula for new earning per share is the old earnings. The old earnings of Mark Limited. First of all, we'll add the old earnings of Mark Limited. So what is the old earnings of Mark Limited? Is 2000 lakhs. So 2000 lakhs plus old earning of Mask Limited 400 lakhs plus if there is any synergy benefit, we are going to add that also. But sir, in this particular question, there is no synergy benefit which is being talked of. Yes, there is no synergy benefit which is introduced in this particular question. So we'll have synergy benefit as 0. We will always write synergy benefit in our question, but if it is not given in the question, we'll add a 0 to the synergy benefit. So synergy benefit will be 0. So what is the synergy benefit? It is 0. Okay, sir, got it. So now what will be the number of shares of Mark Limited? So number of shares of Mark Limited will remain the same. It is 200 lakhs. But number of share of Mask Limited will undergo a change because for 100 lakh shares of Mask Limited, we are not going to issue entire 100 lakhs. Okay, we are going to issue something less, and less means it is multiplied by 0.2 times. It is multiplied by 0.2 times. 0.2 times is the swap ratio. So we will multiply it by 0.2. So the new earning per share post merger is 10.91 per share. So what is the new earning per share post merger? It is 10.91 per share after merger takes place. Post merger acquisition. Okay. It is 10.91 per share. So what is the new earning per share of Mark Limited after acquisition? Always guys, this concluding line is to be written by you after every answer. Do remember to write this concluding line after every answer. It's very, very important to conclude your answer well. That is a essential element in your examination of any practical subject. Not only SPM, BM, any practical subject, conclusion is a must. You have to write conclusion after each and every step. So 10.91 is the new earning per share of Mark Limited after merger. Okay, sir, got it. What's the third part? So 2 parts done, guys. 2 parts done. First part done, second part done. Perfect. What is the third part? Third part is what is the expected market price per share of Mark Limited? Oh, that we have already computed, no? Market price per share of Mark Limited. But guys, that was computed pre-merger. The question is asking that now what is the expected market price per share of Mark Limited after acquisition? We have to now compute the the expected market price of Mark Limited after acquisition. After merger, what will be the price? Okay. So after merger, what will be the price? After post acquisition, what will be the price? Assuming that P ratio of Mark Limited remains unchanged. So the pre-merger P ratio of Mark Limited will be same as post merger P ratio of Mark Limited. What will be the new market price per share? So guys, we are already aware that market price per share formula of any organization is P ratio multiplied by EPS. It's just that we have to find this entire calculation post merger. Okay. So we have to take post merger P ratio. We have to take post merger EPS. What is the post merger P ratio? Post merger P ratio is 10 times. It is assumed that pre-merger P ratio is equal to post merger P ratio. So post merger P ratio is 10 times multiplied by EPS post merger. EPS of Mark Limited post merger. Guys, over here we had already computed the EPS of Mark Limited post merger. It's already computed by us. It is 10.91. So 10 times multiplied by 10.91 per share. So the share price is 109.1 per share. 109.1 per share. This is the MPS of the Mark Limited post merger. If you understood this concept, hit a like button, guys. Hit a like button if you understood this concept. If you understood this concept, hit the like button. So the new EPS of Mark Limited will be 109.1 per share. Okay. Now, next part number 3 is also done by us. Conclusion is to be written after every part. Next part, determine the market value of merged firm. What is the market value of merged firm? What is the market value? That is computed of the merged firm. Entire merged firm market value is computed as what? So the merged firm market value is computed as number of shares post merger multiplied by market price per share post merger. So what is the number of shares post merger? Number of shares post merger is already calculated by us over here, guys, in this part. 200 plus 100 multiplied by 0.2. So 200 plus 20 lakhs. This is the number of shares post merger. Then what is the market price per share post merger? It is 109.1. 109.1 is the market price post merger. Okay, if you multiply both of them, so it is 220 multiplied by 109.1 gives me a figure of 24002 lakhs. Hence the NAV of the merged firm is computed as 24002. 24002 lakhs is the post merger market value of this particular firm. Now you tell me in the chat box whether if I add up the individual shares of both the companies, if I add up the individual shares of both the companies, individual market value of both the companies, will it be higher or lesser than 24 lakh to 24,002 lakhs? Whether it will be lesser or higher than this particular amount? Ideally, it should be lesser because synergy benefit has to be kicked in, if not by way of profits, by way of anything else. So it should ideally be different. But let's see if it's different or not. The next part is asking us to compute the gain or loss to the shareholders of the both company. So what is the gain or loss which shareholders of both the company have experienced because of this merger? What is the gain or loss which the shareholders have experienced post this merger? That we need to find out now. So now value of shares post merger, value of shares pre merger, that is what we need to compute to the individual shareholders of Mark Limited. Okay. Now, shareholders of Mark Limited, what is the new market capital of shareholders of Mark Limited? So, the new number of shares of Mark Limited is 200 lakhs and each share has a value of 109.1 per share. So, 200 lakhs, 2000 lakhs, sorry. $2,000 shares or 200 shares? 200 shares, okay, 200 shares, yes. Okay, 200 multiplied by 109.1. This is the value of shares after merger, 21,820. And what is the value of the shares before merger? Old market capitalization before merger, the value of share was 200 multiplied by the old market price per share. What is the old market price per share? What is the old market price per share? The old market price per share is 100 for Mark Limited. Old market price per share is 100 for Mark Limited. So it is 20,000. So from a market value of 20,000, Mark Limited shareholders have increased to 21,820. 21,820. So 1,820 is the escalation in value, the gain which has been earned by the shareholders of Mark Limited. 1,820. Please write a yes in the chat box if you understood this concept. Please write a yes in the chat box. Yes, very good. All right, yes. So now the next part is we need to compute the gain to the shareholders of Mask Limited. So Mask Limited, what is the new number of shares? New number of shares is 20 lakhs. And what is the new market value? New market value is 109.1. So 20 multiplied by 109.1 gives me a figure of 2182. And what is the old number of shares? Old number of shares is 100 lakh shares, old number of shares. And what is the old market price? Old market price is 20. Old market price of Mask Limited is 20. So this gives me a figure of 2000 market capital. So what is the gain or loss? Again, there's a gain of 182 lakhs to the shareholders of Mask Limited. There is a gain of 182 lakhs to the shareholders of Mask Limited. So hence the gain to the shareholders of Mask Limited or Mask Limited is 1820 and 182 lakhs respectively. So this is the conclusion which definitely we have to show and put in every answer. In every answer a conclusion is a must. So the gain to shareholders of Mask Limited and Mask Limited is 1820. 1820 is the gain to the shareholders of Mask Limited and Mask Limited. Now in this particular question, guys, I'm going to tweak the question a little bit, okay, and you have to answer my question, okay. Now over here you have found out the gain in terms of market capital. Now what I want you to do is you find out the gain on the basis of market price per share and not the total market capital. I want you to find out the gain of both the companies on the basis of market price per share. Market price per share. Okay, what was old market price per share? What is new market price per share? On the basis of that, I need you to find out the gain to individual shareholder. Okay, so over here the market price per share, the new market price per share is 109.1 and old market price per share is 100. So if you talk about per market price per share, what is the gain? It is 9.1 in case of Mask Limited. It is 9.1 in case of Mask Limited. We have computed the gain in terms of total market capitalization. Now I want you to additionally compute the gain in respect of market price per share. I want you to do that. Question is not asking you to do that. I am asking you to do that. Okay. And I also want you to compute the change in market price per share of Mask Limited. Change in market price per share of Mask Limited. So Mask Limited new market price per share is 109.1. This is the new market price per share. The old market price per share is 20 per share. So the gain which accrues to Mask Limited is benefiting a lot, is 89.1 per share. So the gain which is accrued to Mask Limited is 89.1 share. So Mask Limited is actually gaining a lot of benefit out of this merger. Its per share value is increasing from 20 rupees to 109.1 rupees. Is this calculation correct or incorrect? Please tell me in the chat box. Is this calculation correct or incorrect? Please tell me in the chat box. Because I have to introduce you a new concept because of this calculation. Please tell me in the chat box, is this calculation correct or incorrect? Guys, question doesn't ask you to do this, okay? I am asking you to do this. Question doesn't ask you to do this. Please comment in the comment section. Please tell me, is this computation correct or not? Calculation correct, but factually not correct. There are 5 shares market value will be 109.1. I did not understand what you are saying. I did not understand what you are saying. My question is whether this calculation is correct or incorrect. Let's see if someone is able to find out what is the flaw in this calculation if it is incorrect. Okay, let me tell you guys, this calculation is incorrect. This is a wrong calculation. The benefit of market price per share which is accruing to Mask Limited is not 89.1. This calculation is incorrect. This calculation is wrong. Why is this calculation wrong? Let me introduce you to the next concept which we are going to deal with. The new concept is equalization. Concept of equalization. Equalization of MPS or EPS. Equalization of MPS or EPS is the new concept which I'm going to introduce to all of you. Okay. So assume that you have shares of a company, Reliance Industries Limited. You have shares of a company, Reliance Industries Limited, and you are holding 3 shares of Reliance Industries Limited, and the earning per share which you are earning from each share is rupees 2. Now you have number of shares is 3. You have 3 shares of Reliance Industries Limited and you are earning 2 rupees per share out of these shares every year per share. 2 rupees per share is the earning per share. Earning per share is rupees 2. Now Reliance Industries Limited is going to give you a deal, or it is going to give you a scheme of combination. Reliance Industries Limited is saying that we are consolidating our shares. We are combining our shares together. So shareholders, all of you, we are announcing that, we are combining our shares. So for every 3 shares, we will give you 1 share. We are combining our shares. It's known as combination. Shares are being merged to 1. Consolidation. So Reliance Industries Limited is saying we are combining our shares. So the 3 shares of Reliance Industries Limited, we are converting into 1 share. So all the shareholders who are having 3 shares, they'll be consolidated into 1 share. And we are happy to announce that the post-merger, post-consolidation, this is the post and this is the pre-figures, okay? We are happy to announce that after this, consolidation takes place, we will increase your earning per share to rupees 5 per share. This is a declaration which is being made by Reliance Industries Limited. We are consolidating our share. Number 1, for every 3 share, we'll give you 1 share, and we are increasing our earning per share. Wow, it's a big news. We are increasing our earning per share to rupees 5 per share from rupees 2 per share earlier. This is the announcement being made. You are the shareholders of this particular company. Tell me whether this announcement is good or bad for you. Sir, of course it is good. We are earning more. When we are earning more, then this announcement is good for us, sir. What are you even talking about, sir? From 2, we are earning more than double. Wow. 5 rupees per share is the earning per share. Revised earning per share. We are earning double. So, of course, this is good for us. You have to tell me in the chat box whether this announcement is good for you or bad for you. Whether this announcement is good for you or whether this announcement is bad for you, you have to tell me in the chat box. You have to tell me in the chat box. Yes. मेरे सवालों का जवाब दो ना. Okay. One student is saying bad. None of you has any other opinion, huh? Any one of you is having any other opinion? Any one of you has any other opinion regarding this? Is it bad or is it good? It is good. Is it good or is it bad? Aisha Haris. Okay, very good. This announcement is bad for us. This announcement is not good for us. because it is resulting into a loss. So how loss? It is profit. EPS is rising. No guys, you cannot just subtract 2 with 5 and say 3 is the earning per share increase that we are getting. No, this is an incorrect calculation. You have to see that in the old number of shares was more, it was 3. So 3 multiplied by 2, your total earnings was 6 in the erstwhile regime, and now your earning per share is only 5 in the new consolidated regime. So in effect, you are actually reducing your earning per share. Your earning per share is getting reduced and not increased. You cannot compare 2 with 5. Why? Because 2 has been computed on the basis of 3 number of shares and 5 has been computed on the basis of 1 number of share. So these are not comparable. These are not comparable. 2 and 5 are not comparable with each other. But yes, 6 and 5 are comparable with each other. So whenever you are comparing earning per share, you also have to see the number of shares while comparing the earning per share. Otherwise, your answer will be incorrect. If the number of shares on which earning per share is computed is different, then your earning per share cannot be computed like this. So what should we do? What should we do to make both of these things comparable? The concept is equalization of old earning per share. So whatever is your old earning per share, our old earning per share is 2. You divide it by the swap ratio. You divide it by the swap ratio. What is the swap ratio in this case? 1:3, 1 by 3, okay. 33.33333 is the swap ratio. 0.33333 is the swap ratio. For every 3 shares, 1 share is being issued. So 1 divided by 3, which is 0.33333 is the swap ratio. So what I do is I divide 2 by 0.33333 infinitely. So what is the old earning per share? Equalized old earning per share, 2 divided by 0.3333333. So the old earning per share comes out to rupees 6. And now you compare 6 with 5 and then you realize there is a decrease in EPS, which earlier you were thinking that there is an increase in DPS. No, there is no increase in DPS. There is decrease in DPS rather. So you are at a loss. You are suffering a loss. So number of shares has to be same while you are comparing the earning per share. This is the concept of equalized earning per share. Okay. Let us come back to our example. Okay. Let us come back to our question. Okay. Over here, you were comparing the market price per share, right? You were comparing the market price per share, but you are comparing it on the basis of wrong number of shares. I'll tell you how. I'll just tell you how. Just wait a second. I'll tell you what was the wrong thing that you were doing. Okay. Please see. Old market price per share is 20, but old number of share is 100. New market price is 109, which is perfect, which I'm going to write again, 109.1, which is perfect, right? But the old earning per share, which is 20, is not comparable to 109 because old number of shares were 100 and old EPS was 20. So 20 is not comparable with 109. These are not comparable. We cannot reduce both of them. We cannot deduct both of them. This is not possible. So what are we going to do? We are going to equalize the old earning per share. What is the formula of equalizing old earning per share? Old earning per share, which is 20 in this case, divided by the swap ratio. So 20 is the old earning per share, right? So you have to see the equalized old EPS. Equalized old EPS is computed as old EPS divided by the swap ratio. Swap ratio is 0.2. So 20 divided by 0.2 is 100. 20 divided by 0.2 is 100. So the old EPS, equalized old EPS is 100 for Mask Limited also. So the benefit which shareholders of Mask Limited get is also 9.1, same as what was received by Mark Limited. And the earlier answer 89.1 is incorrect. 89.1 is incorrect. So the ask is, or the concept is, whenever you are required to compare the EPS and MPS, per share, any value which is per share. Whenever you are required to compare the per share value, if you are required to compare the total value, then no equalization required, no problem at all. If you are comparing total earnings or if you are comparing total market price, no equalization required, no problem at all. Equalization is not required if total earnings are required to be compared or total market price is required to be compared, no equalization required. But if the question specifically asks you to compute the difference between earning per share, if the question wants to ask you the difference between earning per share or market price per share, what is the increase or decrease in the earning per share or market price per share, in that case, equalization is required for the old EPS or old MPS, as the case may be. Equalization is required in both these cases. After equalization, the gain or loss is computed as 9.1 and 9.1 in case of Mark Limited and Mask Limited respectively. This is the concept of equalization of old EPS or MPS. Please see this concept. Equalization of EPS or equivalent EPS. In case of merger of bidder company and the target company, number of shares of the target company undergoes a change. Now this is an important point, that target company number of shares is changed. Okay. In such a situation, if one wants to compare the pre-merger EPS with post-merger EPS of shareholders of the target company, it would not yield the correct results. The reason is simple. Old EPS is computed on the basis of pre-merger number of shares and new EPS is based on the post-merger number of shares. Number of shares is different. Therefore, the difference will not be streamlined, right? Hence, before comparing the two EPS of target company, the old EPS should be equalized. This is the concept of old EPS equalization. What is the formula? Formula is equalized old EPS is equal to old EPS divided by the swap ratio. Equalization is required for target company only, not for bidder company, because bidder company number of shares doesn't change. Bidder company number of shares remain the same. Therefore, equalization is required for the target company only. Plus one very important thing, if the swap ratio is 1, suppose the swap ratio is 1, there's no change in the number of shares of the target company also, then no equalization is required. Then no problem, don't do any equalization. Okay, so this is an important concept which you should understand and know. And yes, growth, growth is a very important concept which requires your attention. How to compute the growth? The formula of growth is very simple. Retention ratio, whatever we are retaining out of our profits which are reinvested into business, retention ratio multiplied by return on equity. This is the formula for growth. We'll use this formula in many questions henceforth in going forward. So please remember this formula of growth. Retention ratio multiplied by the return on equity. Whatever we retain out of our profits multiplied by the return on equity, you will get the growth percentage. Whatever growth you will find, you will get the growth percentage if you multiply the retention ratio with the ROE. So this is the formula for growth. Okay, sir, got it. Let's start the next topic, and very, very important topic from an exam standpoint also, because a question mandatorily comes from this particular topic, which is value of firm. How is a firm value calculated? Valuation of a firm done. Valuation of a company done. What is the process of valuing a particular company? So this is a value of a firm. So guys, discounted cash flow is the most common method which is used to value any organization. Okay, if I want to value any organization, I will see what profits will it give me in the future. I will discount all those profits in the current period, and then I will value that particular organization. So valuation is nothing but discounting of the future cash flows. Whatever future cash flows are there, I discounted at the current period, at the current discounting rate, and then I compute the value of the firm. So the formula is very simple. Discounting all the cash flows of a particular firm which it is expects to incur in the near future, we discount it at a present value, and that is known as the value of the firm. Now the problem arises when this discounting happens for an infinite time period. If the question gives us that yes, for infinite time period, for unlimited time, the revenue is going to be earned from this particular company, then the problem arises. And for that we have a capitalization formula, and the formula is this, that value of the firm is equal to free cash flow from the firm divided by the KE. A very simplistic formula without growth. So whatever the firm is going to earn in the next year, that divided by the cost of equity of the current year, overall cost of capital of the current year, that will be the formula for a firm which is earning a particular expected revenue for the infinite years, for the entire life. If they are earning the revenues, what will be the valuation? So free cash flow divided by the cost, this is the formula. Now if growth element is also there in the question, if it is given in the question, then the formula changes a little bit. What is the change formula? Change formula is free cash flow plus 1 plus growth rate. Free cash flow multiplied by 1 plus growth rate divided by cost of overall cost of capital minus growth. Overall cost of capital minus growth. This is a formula which you need to remember. Always remember that free cash flow of the next year will give you the revenue, the value of the firm of the current year. Free cash flow of the next year will give you value of the firm of the current year. So free cash flow of the next year divided by the overall cost of capital minus growth rate is the value of the firm of the current year. This is the formula of the value of the firm. Okay. Now, what do you mean by free cash flow? It means earning before interest and tax into 1 minus tax rate. So usually we do not exclude interest from this calculation. Interest is included because we are calculating free cash flow of the entire firm. Okay. Then earnings before interest and tax rate. Then cost of capital or weighted average cost of capital is usually used in the KO formula. What is weighted average cost of capital? Weighted average cost of capital is nothing but cost of equity multiplied by weight of equity plus cost of debt multiplied by weight of debt. That is the weighted average cost of capital which is computed. Okay, so then growth rate is always a part of this calculation, because growth is added in the numerator, growth is reduced in the denominator. That's why growth forms a essential element of this particular calculation. Okay, let's directly jump on to a very good question which came in June 2025 attempt, and it's a very good question, guys, which has been drafted. So two firms, Rajan and Rekha Corporation, operate independently and have the following financial statements. Financial statements are given for two firms who are operating independently. Rajan is operating independently. Rekha is operating independently. 8 lakh worth of revenue, cost of goods sold 6 lakh. So 2 lakh is the EBIT, and 4 lakh is the revenue, 2,40,000 is cost of goods sold, and 1,60,000 is the EBIT. Expected growth rate is 6% and 8% for both the organizations. Cost of capital is 10% and 12% for both the organizations. Both the firms are in steady state with capital spending offset by depreciation. So there is no depreciation expense. The entire capital is depreciated in one go. No working capital is required, and both the firms face tax rate of 40%. 40% is the tax rate which is given for both the firms. Combining the two firms will create economies of scale in the form of shared distribution and advising cost. If we combine these two firms, then there will be synergy benefits. Synergy benefits is given to you in form of reduced cost of goods sold from 70% of revenue to 65% of revenue. So cost of goods sold, which currently is 6 lakh divided by 8 lakhs, this is 75%, and 2,40,000 divided by 4 lakhs, this is 75%, and this is 60%. Okay, 2,40,000 divided by 4 lakhs, 60%. Okay, so 75% and 60% for the combined organization. If they combine together, then the new cost of goods sold will be 65% of the revenues. It will undergo a change. It will be 65% of the total revenue. The combined cost of goods sold will be this. Assume that firm has no debt capital. There is no debt capital. You have to compute the value of the two firms before merger. What is the value of the two firms? First of all, you have to compute before merger, and then value of the firm, combined firm with synergy effect after merger. Value of individual firms before merger, and what is the value of the combined firms with synergy effect after merger. These are the two things that you need to compute. So guys, to compute the value of the firm before merger, it's very easy. We just use the individual data to compute the individual value. Simple. Okay, let's first of all do the first part, because first part is very easy. So the calculation of free cash flow will be EBIT into 1 minus tax rate. Okay. 2 lakh and 1,60,000. 2 2 lakh and 1,60,000. This is 1,20,000. This is 96,000. So what is the free cash flow? Free cash flow is this. Free cash flow is this. One lakh 20,000 and 96,000. Now we just put this free cash flow into the formula. So Rajan, one lakh 20,000 and Rekha 96,000. We'll use the individual growth rates of both of these entities. 6% is the growth rate for Rajan and 8% is the growth rate for Rekha. 6% and 8% respectively. Okay, so 1,20,000 plus 6% divided by the cost of capital minus the growth rate. Okay, cost of capital is already given in the question. 10 and 12 is the cost of capital. So 10 minus 6% is 4%. So divide by 4%. The value is computed as 31,80,000. And guys, please compute this value. Most students are doing error in computing this value because this divide by 4% is little tricky. Divide by 4% is little tricky. So please compute this 31,80,000 yourself on a calculator. Now I calculate the value of Rekha Limited. 96,000 plus 8% divided by 4%. So what is the value of the combined firm? Value of the two firms independently. Value of the two firms independently is 577,200. 577,200 is the value of the combined firms, value of the firm individually without combination. Without combination, these two firms individually will be valued at 577,200. Okay, now the ask is that we need to now compute the value of both the firms combined together. If both the firms combined together, then what will be its value? The combined revenue is to be taken, the combined synergy benefit is to be taken, everything is to be taken combined. Okay, now what is the combined revenue of both the firms? The combined revenue of both the firms will be 8 lakhs and 4 lakhs. So the combined revenue is 12 lakhs for both the firms. Now what will be the cost of goods sold? Cost of goods sold will be 65% of 12 lakhs. Okay, because the question specifies that after combining, the cost of goods sold will be 65%. So 12 lakh multiplied by 65%. So the cost of goods sold will be 78,000. The cost of goods sold will be 78,000. So 12 lakh minus 78,000. So the EBIT will be 11,22,000. EBIT will be 11,22,000. Okay. Now we need to compute the cost of capital. Now guys, individual cost of capital is given to us 10% and 12% is the individual cost of capital of both the companies. And individual growth rate is also given to us 6% and 8% is the individual growth rate of both the companies. We have to compute the combined growth and combined cost of capital. Sir, simple. You add both of them, 14% and 22%. You add both of them to calculate the combined growth and combined cost of capital. No guys, this is wrong. We don't combine, we don't add in this particular case. We don't add both the growths to compute the new growth or both the cost of capital to compute the new cost of capital. We don't combine that. We prorate them on the basis of their values. I'll tell you how. So 6% and 8% is the growth rate, right? Okay, first let's calculate the weighted average cost of capital. So 10% is the cost of capital of Rajan, and 12% is the weighted average cost of capital of Rekha. So we're going to prorate it. Okay, so 10% is of Rajan. So 10% multiplied by 31,80,000 divided by 57,72,000, and 12% multiplied by 25,92,000 divided by 57,72,000. You'll prorate the cost of capital using the value of the firm, value of the individual firm. You'll prorate it. So you'll prorate it using the value of the individual firms. That is a very important step to do. 10% is the individual cost of capital of Rajan, and 12% is the individual cost of capital of Rekha. Now you prorate both of them. Okay, 10 divided by 5,772,000 multiplied by 5.51. 12 divided by 5,772,000 multiplied by 2,592,000. 5.39. What is the combined cost of capital? Anyone if you computed it, please tell me in the chat box, because I want you to compute it. That's the whole point. I want you to compute it. I don't want to just compute it, put it on the board and then you copy it. I want you to compute it. .9%. 10.9% is the combined cost of capital. The combined cost of capital is 10.9%. What is the weighted average expected growth rate? What is the growth rate? Again, same pro rata technique is to be used, guys. 6% is of Rajan. Rajan's value is 31,80,000 out of 57,72,000. And Rekha's value is 25,92,000 out of 57,72,000. 57,72,000. Out of that, 25,92,000 is the value. Okay. So 6 divided by 5,772,000 multiplied by 31,800. This comes out to 3.31. 8 divided by 5,772,000 multiplied by 2,592,000. 3.59. This comes out to the second answer, please. Second answer, please. Please write in the chat box. .9%. 6.9%. .9%. Okay, please let me know in the chat box if you understood this concept well. Okay, so now we are good to go. Okay, our growth is approximately 7% and the cost of capital is approximately 11%. Our growth is 7% and cost of capital is approximately 11%. Now, what is the value of the firm with no synergy? If there's no synergy at all, what will be the value of individual firms? Okay, now the question has specifically hinted you. Please see this. So, combining the two firms will reduce the cost of goods sold from 70% of revenue to 65%. So, without synergy, the revenue as a percentage, cost of capital as a percentage of revenue will be 70%, and after synergy it will be 65%. So, before the synergy kicks in, it will be 70%. So, total revenue is 12 lakhs in both the cases. Total revenue is yes, 12 lakhs in both the cases, 12 lakhs and 12 lakhs. Total revenue is 12 lakhs in both the cases. And now we are reducing the cost of goods sold from this particular 12 lakhs. So 70% in the first case and 65% in the next case. 12 lakh multiplied by 70%, this comes out to 8 lakhs 40,000, and 12 lakhs multiplied by 65% comes out to 7 lakh 80,000. Four lakh 20,000. What will be the growth rate? Growth rate will be the combined growth rate we have already computed, guys, 7% and 7%. Okay. And what will be the cost of capital? Cost of capital will be 11% in both the cases. Cost of capital will be 11% in both the cases. So what will be the free cash flow after the taxes, EBIT after the taxes? So 3,60,000 minus tax rate is 40%. Comes out to 2,16,000 in the first case, and 4,20,000 minus 40% comes out to 2,52,000 in the second case. 2,52,000 in the second case. Now we will compute both the values, one with synergy and one without synergy. One is with synergy and one without synergy. Okay, so value of the firm without synergy, 2,16,000 multiplied by growth, 11% minus 7%. 11% minus 7%. So 2,16,000 multiplied by 1.07 divided by 11 minus 7 is 4%. So value without synergy is 577,800, and value with synergy is 252,000. 2,52,000 plus 7% divided by 4%. 674100. This is the value. So what is the value of firm with synergy? Value of firm with synergy is computed as under. Please let me know if you understood this concept well. Yes, please write in the chat box if you understood the concept well. So this is the value of the firm with synergy, value of the firm without synergy. This is the answer. 57,78,000 and 67,41,000. And the individual values, okay, without any calculation, the individual values was 57,72,000. 57,72,000, which was almost equal to this value, 57,72,000, almost equal to the value with no synergy. So yes, a value with no synergy can also be computed by combining the individual firm's value without synergy. That can also be one of the methods. So this is the value of the firm with synergy and without synergy. Okay, sir, got it. Okay, let us now see one more question which is really interesting. Came in June 2025 attempt, guys. Tweaking our computation a little bit and using the concept of discounted cash flow, that is the regular discounted cash flow, in great detail. Okay, let's see this question. Illustration number 4. Pritham Limited is considering acquisition of Soham Limited. So Pritham Limited is the bidder company. Soham is the target company, okay, which has 3.1 crore shares issued. So Soham Limited number of shares is 3.1 crore shares, okay. The market price per share of Soham is 440. Market price per share is 440. Pritham Limited average cost of capital is 12%. Pritham Limited cost of capital is given to you. Soham market price is given to you. Cash inflow of Soham is given to you for next 3 years. This is the cash inflow of next 3 years. 460 crores, 600 crores, 740 crores. You are required to calculate a range of valuation that Pritham has to consider. So what can be the range of valuation that Pritham can consider, based on the data which is given to you. Market price is given to you. Okay, market price of Soham is given to you. That can be one of the ways of calculating the value of Soham Limited. And the second way of calculating the value of Soham Limited can be the discounted cash flow. And that is how you'll develop a range. Range means 2-3 valuations need to be computed. Okay, sir, got it. All right, let's start. So first of all, what is the market price per share of Soham Limited? It is 440. And purely based on this market price, which is 440, what is the current price of Soham Limited? It is 440 multiplied by 3.1 crores number of share. 440 divided by 3.1 crores. So the total value of Soham Limited, the first range, okay, this is based on MPS. So the value of Soham Limited based on MPS is computed on the basis of the data which is given in the question itself. Question itself is giving the data. So we need not call out the data. The question itself is giving us the data. So the value of Soham Limited is 1364 crores. This is the first range, okay. Now we will calculate another value of Soham Limited based on the discounting cash flow. The cost of capital percentage is given to us 12%, and based on the cash flows we will calculate the present value, okay. Now it is rupees 460 crore. Present value factor is to be written over here first. So 1 divided by 1.12. I hope you understand the calculation of present value factor, okay. It is 1 divided by 1.12. This is for the first year. 0.893. This is for the first year. I do an equal to. This will give me the PF for the second year. So PF for the second year is 0.797. This is for the second year. I do another equal to. This will give me the PVF for the third year. So PVF for the third year is 0.712. This is the PVF of the third year. I hope you understand this computation well, because this computation is going to be really important, okay. So this is the PVF of the 3 years. Now 460 multiplied by 0.893. This is 410.78. 410.78. I put it in M plus because I have to get the total as well. So 600 multiplied by 0.797. This is 478.2. M plus again. Then 740 multiplied by 0.712. Again M plus. 526.88. Then we'll do a MRC. The total value is 1415.86. So please understand how to use M plus and MRC in the examination. That's going to be really important for you. Okay. So 460 into 0.893 M plus 410.7. Okay. And 600 multiplied by 0.797 M plus 478.2. Then 740 multiplied by 0.712 again M plus 526.88. MRC 1415.86. This is the value based on discounted cash flow. This is the value of Soham Limited based on discounted cash flow. Because we were required to compute a range, we were not required to compute one value. We were required to compute a range. So this will tell us the range of values. Okay. So now, what will be the range of valuation? First of all, based on market value. What is the value per share based on market value? Value per share is 440 and the total value is 1364. And on the basis of discounted cash flow, What is the per share value? Per share value is 1415. Okay. Per share value is 1415.86 divided by 31.1 crores. Okay, no, 3.1 crores. Okay. 3.1 crores. 3.1 crores. This gives me a figure of 456.73. So the other value per share is 456.73 and the total value is 1415.86. The total value is 1415.86. This is the total value. So you can write the conclusion also. You can write the conclusion also. Hence, the range of valuation, the range of value per share, right, like this. The range of value per share of Soham Limited is computed as rupees 450 to rupees 456.73. Rupees 440 to rupees 456.73. Full stop. This is computed on the basis of market value and discounted cash flow. Full stop. The similar value of the total value on the basis of similar parameters. The total value on the basis of similar parameters is computed as rupees 1364 crores to rupees 1415.86 crores. The acquisition may happen within this price range. So yes, this is the valuation which is done for this particular case. So guys, these were the practical questions which I want to discuss with you. Now, I have given some practice questions also in this PDF itself. It's a huge PDF. I've given practice questions of many past attempts, RTPs, MTPs, institute, study mat, etc, etc, etc. So it's really important for you to attempt each and every question which is given in this particular PDF to all of you. Also, I've given some MCQs at the back of this particular PDF which you can refer to, because it's really important. In this chapter is important from a MCQ standpoint also, and I've already told you about 15 to 20 marks will come from this particular chapter. So it's not a chapter which is to be let loose or to be taken easily. You have to actually attempt all the questions which have come from this particular chapter in past, including the past examination question. You have to attempt all of them. Practice question, you have to attempt all of them, and practice at least thrice, and that too in writing. Practice these questions thrice, that too in writing. Only then will you be able to attempt a question in the examination on a full-fledged basis. So yes, that's all for this particular session, guys. Yes, this was end of merger and acquisition chapter, and tomorrow we're going to start a new chapter. So yes, please get yourself enrolled in the WhatsApp group. If you're looking at these videos afterwards, recorded versions, then you need not get yourself added in the WhatsApp group. The PDF is saved on your system itself. The app has got the PDF, so you can refer to the PDF over there. And yes, we'll be covering all the important topics of SPM BVM in our forthcoming lectures. So yes, on that positive note, all the very best and happy studying. Bye bye. See you in the next session.